short position that we had in the forward transactions has come down significantly from about 8 billion to the latest published figure of 5 billion. The bulk of this increase in our net position is not due to borrowing. Also, it is not due to the foreign portfolio inflows that many people have been talking about. This is primarily due to the improvement on the current account deficit. And on the foreign portfolio inflows, I wanted to also take this occasion to clarify that they account for only one-fifth or less of the improvement that has occurred. The rest is coming from the reduction in the current account deficit. Now, why is this situation with respect to our reserves important to us? There are, of course, many reasons why they are important. But one reason should be very close and dear to your hearts, and that's on the next slide. And that shows in the vertical shaded areas are all the years that Pakistan has had to seek assistance from international financial institutions, particularly the IMF. And the area that 95 we had a we got out of them. Two more since then, and now the most recent one. Well, the message that I'd like you to take away from this is that the one single best predictor of whether or not Pakistan has had to go to the IMF is a low or falling level of reserves. So if we as a country want us to be independent of having to go to IFIs, of having adequate self-insurance, then it is imperative that we build our reserves to a level where when we have external shocks, we can manage without seeking assistance. There are two key developments from the start of this fiscal year which make us optimistic that going forward things will be different. And the first is that we have made a transition to a market-based exchange rate system. This, as you remember, when we began this journey, was not an easy journey. And a few months back, if you spoke about the exchange rate, many people would be talking about numbers and predictions that I'm sure you're all familiar with. I'd like to ask you to reflect that today, people are not talking about those numbers. We have completed the transition to a market-based system. The State Bank does not give guidance to the market. The market itself is moving. We don't stand against the trend. We do step in if we feel there are disorderly market conditions. And preserving this change will assure us that next time, if there is pressure on the current account, that it does not result in a loss of reserves, which in turn, as you see from this chart, results in going and seeking international financial assistance. I want to, on this occasion, thank the bankers here and the heads of their treasuries, because this move of the exchange rate system was done in coordination with them. Some of the bankers who are here will remember the meetings we had, small meetings with the presidents and their treasurers to explain to them what is coming, how we are going to do it, and to plan for it. And I want them today to also feel proud and to thank them for their support of how they teamed up with us to make this transition, and to tell them and the rest of the audience that this is a shared goal. And if we all now stick to it and own it and recognize the benefits of it, then we are going to self-insure ourselves. The other key development that makes us think that it's different this time around is that the State Bank is no longer lending to the government. Not 1 rupee has been lent since the beginning of this fiscal year. And that is important because when a government borrows from a central bank that is akin to printing money, that is inflationary, and that results in a loss of net foreign assets of a central bank. So these two in particular changes we feel will help us to ensure ourselves better for potential external shocks in the future. Now this was on the external side. Second key reason why we've had difficulties is on the fiscal side. And on the fiscal side, a key part of our vulnerability, our Achilles heel, has been our revenues. And this chart is striking to us because it shows that there has been a very significant turnaround in the revenue performance of the country. This is as important as the reduction in the external deficit for helping us to get out of the problems that we faced. And finally, on the policies that are addressing the macro imbalances is the much talked about subject of interest rates. And this, I want to show you a chart about where we stand relative to other countries, and this chart shows you real interest rates that economists generally use when they want to assess the tightness or looseness of the stance of monetary policy. And real interest rates are simply nominal interest rates minus expected inflation. And this shows many different emerging markets and compares Pakistan to them. And you will see that the level that Pakistan is at, around 2% or so, is first of all in the middle of the distribution of these countries. And this chart is a little bit skewed because the countries on the far right, Ukraine and Argentina, their real interest rates are actually much higher, but we truncated the scale so that we can fit them. But also from the perspective of our own history, if you look at our real interest rates, they've averaged around 3%. So even from the perspective of our own history, real interest rates are lower than our long-term average, and our nominal interest rates are actually lower than what they have historically been just a few years ago. Now, the first message that I wanted to convey was that the economic policies that have been put in place are helping to address the imbalances. Second, very important part of what I want to say is that the outlook for the real economy, in our view, is improving. It will take time because the magnitude of issues was large. Any turnaround takes time, but we do see some signs for us to be hopeful. And I want to share some of these with you. And the first is related with the outlook for our export sector. And this is a depiction of the competitiveness of exchange rates of countries, real exchange rates that are all indexed to 100 in 2013. And we are showing to you what happens to the Pakistan rupee's competitiveness compared to a range of several other emerging markets which are our competitors in international markets. And you will see that we steadily lost competitiveness. When we steadily lost competitiveness, we essentially taxed our exports and we subsidized our imports. But the point that I would like you to take away from this is that since the exchange rate was allowed to be flexible, Pakistan's rupee is back squarely in the range of competitiveness of other countries. And the corollary from that is that the outlook for our export-oriented sectors is better than it was a few years ago. Anecdotally, and in the balance of payments data, you do see that exports are now beginning to grow. And it gives us hope that this trend will continue. There is, of course, a lot more needed. There is a need for investment in capacity. There are areas to be covered by government agencies, but the exchange rate has played a part, and this is the first reason why we are hopeful. The second reason why we are hopeful is shown in this chart, which has to do with the government. Notwithstanding the considerable reduction in the fiscal deficit, the outlays on development spending are actually increasing at a very sharp clip. And this is important because a lot of this spending is going to feed into the real economy. A lot of this spending is related to construction, to building roads, and this in turn through linkages supports other sectors of the real economy. It'll take a quarter or two for this to filter in, but I would like you to please note the magnitudes of spending this fiscal year than in the last fiscal year. The third point that I want to make on the outlook for the real economy is that, as some of you may be aware, the IBA does a survey of business confidence for the State Bank, which we use in our analysis, including when we have meetings of the Monetary Policy Committee. And this chart shows you the results of the most recent survey. And the way to read this chart is that if the arrows are upwards, they mean that the indicators of confidence have improved, and the green versus the red simply shows the level at which the indicators stand. But the point I want to make to you is that for the first time in several months, I think around 6 months if I'm not mistaken, these indicators have turned positive. These are the indicators from a survey of businesses. And that's an encouraging sign as well. Could we move to the next slide, please? So, as we look ahead then, I want to share with you what are some of the priorities that we have in front of us. And I'm going to not talk about the very specific issues of exchange rates and interest rates, because these are areas that we are constantly looking at, but stepping back and looking at slightly longer term priorities. And there are three. The first is to do with exports. And I find this chart to be quite striking, which on the left shows the ratio of our exports to GDP starting from about 1970, when it grew, and then it falls. And today, at a level below 10% of GDP, it puts us in a club of countries that is indicated in the panel on the right. In the chart on the right, the countries in the red are those countries whose current export to GDP ratio is less than 10% of GDP. These countries include ourselves, Afghanistan, Yemen, Sudan, South Sudan, and Ethiopia. So, we need to figure out what to do to regrow our exports and to get out of this club of countries. We should be hopeful because we have done this before. Our exports were double what they are right now in percent of GDP. So clearly it is within us. But as a priority for the State Bank, promoting exports, which in turn is a sustainable source for us to grow our reserves, is a very important area. Many parts of the public sector need to do their part. For our part, we have specialized schemes which the business community and you as bankers, your trade side is very well familiar with, the EFS and the LTFF. We have increased the amounts on those. We are increasing more amounts. You will be getting more announcements. And particularly for the LTFF, we are going to open it up to a few other sectors as well, so that more export-oriented sectors can benefit from it. So while monetary policy is where it is, the point we want to make is that for exporters, the cost, whether it's working capital or it is financing for capacity development, is a lot less, 3%, 5%, 6%, in that range. The second key priority for us is our savings rate. And you will see in this chart, Pakistan being on the very left and some of our neighboring countries in the other panels, and some averages for countries. Pakistan showing up not only low in terms of levels compared to other countries, but also having reduced our saving rate. While other countries have increased their saving rate, we have reduced it. Saving is just what's left after consumption. So the point simply is that there has been a greater emphasis towards consumption rather than saving and investment. And the reason increasing our saving rate is very important for the state bank is that our investment needs are going to need to rise. If we have to grow higher, our investment rate has to increase. If we have to finance that investment rate without going back to current account deficits, then we have to raise our domestic savings. So I welcome the ideas that bankers have and others to increase our level of savings. And the third priority area that I want to mention is that of inclusion, financial inclusion. And the reason it's very important for the state bank is that the prosperity that we feel confident will come in the future also we need to worry about that prosperity being shared. Now, that's also an area where many public institutions need to do their role, but for us, for the state bank, where we can contribute, one of the areas where we can contribute is in promoting the agenda on financial inclusion. These two panels show you, the one on the left is account ownership, first total, then by gender, and the one on the right is SME credit in percent of GDP. These two show you that we have a long way to go. We have done some improvement. I thank the banks that have worked with us in addressing some of them, but the message on this is that we have a long way to go. And it is a priority for us because it's one area where we can contribute to help to share the prosperity better than it has been done before. So I wanted to share with you the outlook of the state bank for our economy. But I want to quickly then mention to you for the banks. Where do we see where banks as a whole have been doing well? Where do we see they can partner with us more? And in the first area, I'll mention a few things. The capital adequacy ratio of our banks is very good. It's higher than international standards. There is some range in it, but all our important big banks have a very good capital adequacy ratio. NPLs have recently risen a bit. Some of it is due to the slowdown in the economy. Some of it is due to the foreign portfolios of our banks. But our banks have provisioned. 80% are provisioned, which means that the net NPL ratio is around between 1 and 2%, while the overall NPL ratio may be around 8 and 9%. So the fact that the banks are provisioning is welcome. The profitability of our banks is good. The critics would say that the sources of this profitability are questionable because banks are primarily using deposits to invest in government securities, but nevertheless, it is much better to be a regulator of a banking sector where the banking sector by and large is profitable than otherwise. And I want to say that banks have worked with us in addressing many of the challenges that came to us from FATF. There were big issues, there are issues, but on the financial sector side we have made a lot of progress and many of the banks have worked with us in that area. There is more to be done there. We are not off the hook yet. We are confident that we are going to get off the hook, but not yet. And we encourage banks to continue to work with us in this area. Now, while these are some of the areas where we think that our banks should be recognized for the good work that they are doing, I also want to encourage the banks to focus on a few areas looking ahead. And this is the last point that I want to make. And the first has to do with lending to the private sector. This is not a new point, but it is striking the extent to which banks' risk appetite has shrunk. It is having an impact on the economy. As we see financial conditions improving, we see that lending will grow. But I want to encourage our banks that as this happens, to not just cater to the big, safe clients. Banks have to move across the other segments. For us, SMEs is very important, agriculture is very important, housing is very important. We have dedicated schemes where we provide refinance, but the take-up from banks is very low. So we want to encourage banks to dedicate some resources to this, and banks are best placed to figure out how to do this. And we want to ideally achieve this goal through a system of carrots and not sticks. So we are working on carrots. Many of the carrots exist. But we are also prepared to use other means, if needed, to get banks to direct more lending. Because this can get ahead of ourselves. If we, as the banking sector, are not perceived as doing a better job of catering to the smaller borrowers and also the smaller retail clients of banks, banks themselves will find themselves on the defensive, and I don't want banks to be there. So it's a priority that I would like all the bank presidents who are here to own. Finally, I want to talk about an area which is getting a lot of attention, which is the ease with which small customers of banks can do banking transactions. As banks have become more risk averse, partly due to AML, CFT considerations, partly due to increased compliance, there is a big burden right now and a lot of complaints coming, particularly from the small guys. The big guys, as you know, can find ways to get whatever they want to get done. But the small guys, people who want to open an account, anecdotes about a driver who's trying to send money to his village, trying to open an account, not being able to do so, anecdotes about people, account holders getting lots of questions. While some of this may be legitimate, I am being told that the extent of this happening has become very, very significant. And I would like to encourage all the banks to take a close look at what is legitimate compliance and where there may be some excessive amount of compliance being done. Similarly, inward remittances. We are seeing and being told that the use of formal channels for sending money is not growing as much as the use of informal channels. Partly, this has to do with the cost of sending money home. It also has to do with increased compliance and the number of questions that are being asked of senders who want to send foreign exchange home. I want to encourage all of the banks here to try to think of how they can meet their twin goals of ensuring compliance, but also seeing that particularly the smaller retail clients are served in a fair manner and the disruptions that they are facing are addressed going forward. I've taken up much more time than I intended to. Let me close by thanking again the organizers of this event, and let me say that I'm very much looking forward to discovering who are the winners of the awards today, and let me congratulate the organizers of this event and also the winners of tonight's evening. Thank you very much.
They were discussed in great detail, and a very important message, I'm sure, has been conveyed today at this forum. Thank you once again.
But the delays were unavoidable.